You check your portfolio every day, wondering if you're making the right moves. You read the headlines about Warren Buffett buying this or selling that, trying to decode what the world's greatest investor actually knows. Here's the thing, what you think you know about Buffett's strategy isn't wrong, it's just catastrophically incomplete. I've spent years tracking what the smart money actually does, and here's what shocked me about Buffett's latest moves. While everyone was obsessing over his Apple stake, he quietly built a massive energy empire. Occidental Petroleum now makes up 6% of his entire portfolio, that's nearly $14 billion worth. Add in Chevron at 4%, and suddenly you realize Buffett has over 11% of his holdings in just 2 oil companies. This is the same guy who once said he'd never invest in airlines because he couldn't predict fuel costs. But here's the twist that changes everything about how you should think about his strategy. Remember when everyone said Buffett didn't understand technology? Well, Alphabet sits at 4% of his portfolio, representing billions in Google stock. But here's what's fascinating, this isn't some desperate attempt to stay relevant. When you look at how he talks about Google, he describes it exactly like his favorite businesses from the 1980s, dominant market position, pricing power, and cash flows that seem almost unfair. He's not buying tech because it's trendy. He's buying Google because it acts like the newspapers and consumer brands that made him rich decades ago. And that reveals something crucial about what he's really looking for. Here's where it gets interesting. Chubb Limited sits at 4% of his portfolio, and most people have never even heard of this company. But Buffett built his entire empire on insurance businesses, and Chubb is basically his latest masterpiece in that playbook. While retail investors chase the next hot stock, Buffett is quietly accumulating shares in a company that collects premiums today and pays claims later. It's the same strategy that funded his Apple and Coca-Cola purchases, using other people's money to invest. When you see a 4% position in an insurance company, you're not just looking at a stock pick. You're looking at Buffett's financing strategy for the next decade. Now here's where Buffett's emotional side shows through his legendary discipline. Kraft Heinz still represents 2% of his portfolio, even though it's been one of his most painful investments. Most investors would have cut their losses and moved on, but Buffett keeps holding. Why? Because he believes in the underlying brands, even when the stock price doesn't. This is the same logic behind his 1% stake in Delta Airlines. He's betting on recovery, not momentum. It's a reminder that even the Oracle of Omaha makes mistakes, but he handles them differently than you or I would. And that difference is worth understanding. This is where Buffett's genius really shows. Look at Moody's Corporation at 2% of his portfolio, or VeriSign at 0%. These aren't exciting companies, they're boring monopolies that most people ignore. Moody's rates bonds, VeriSign manages internet domains. Both have pricing power that would make a mob boss jealous. While everyone's chasing the next Tesla or GameStop, Buffett is collecting shares in companies that quietly raise prices every year because customers have no choice. Even SiriusXM at 1% fits this pattern. Once you're locked into that car subscription, you just keep paying. But the real pattern isn't what he's buying. Here's what separates Buffett from every other billionaire investor: he still shops for groceries. Well, maybe not literally, but his 0% stake in Kroger shows he understands something about recession-proof businesses that Silicon Valley VCs miss completely. People need to eat, whether the market's up or down. Same logic applies to his tiny 0% position in the New York Times. People consume news in good times and bad. These aren't growth plays, they're survival plays. When the next crash comes, these boring businesses will keep generating cash while tech stocks crater. That's not even the most important lesson from his portfolio. Here's the truth nobody wants to tell you: you can't just copy Buffett's portfolio and expect the same results. He's got a 60-year head start and access to deals you'll never see. But you can copy his principles. He's not chasing momentum or trying to time the market. He's building a collection of businesses that will keep making money whether the economy booms or busts. Energy companies with real assets, tech companies with monopoly power, insurance companies that finance other investments. The pattern isn't about specific stocks, it's about buying companies that get stronger during chaos while everyone else panics. Look, you don't need Buffett's billions to start thinking like him. This week, take these steps. First, look at your portfolio and ask yourself which companies would still be profitable during a recession. Second, stop checking stock prices daily. Buffett doesn't. Third, focus on businesses you actually understand, not whatever's trending on social media. The goal isn't to get rich quick, it's to build wealth that lasts. If you want deeper insights into what the smart money is really doing, visit nexusaicalls.com. Your future self will thank you.